Coming up on Market to Market, checking economic conditions at Thanksgiving, the Main Street View with Ernie Goss, and the Commodity View with Chris Robinson. Next.
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next, because at Pioneer, our name is our mission.
For over 45 years, Steiner Tractor Parts has shared your love of antique tractors, new parts for old tractors. Learn more at steinertractor.com or at 877-559-7887.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
This is the Friday, November 29 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. The economy was a major talking point of the November elections. This week, major snapshots on new home sales, durable goods, and the government's preferred inflation measure are all slated for release. We are recording this episode before those reports drop, but there is still plenty to talk about as we focus on what might be next for the economy, for rural and Main Street America. Ernie Goss is the McAllister Chair and Professor of Economics at Creighton University in Omaha, Nebraska. Chris Robinson is Managing Director of Agriculture and Commodities at TJM and a regular market analyst on the program. We'll talk to the two of you in just a moment, but first, the numbers following the first two trading days of the week. For that shortened trading week, the nearby wheat contract fell 7 cents and the March corn contract lost 7 cents. Ideal weather again kept expectations high for a South American crop. The January soybean contract was even, while January meal dropped a dime per ton. March cotton expanded 91 cents per hundredweight. Over in the dairy parlor, December Class 3 milk futures found 33 cents. The livestock market was mixed. February cattle fell 50 cents. January feeders put on 380, and the February lean hog contract gained 260. In the currency markets, the U.S. dollar index declined 53 ticks. January crude oil weakened 271 per barrel. COMEX gold tumbled 84.10 per ounce. And the Goldman Sachs commodity index lost more than 4 points to settle at 541.65. Let's get going on this panel here. Chris, I'm going to get to you in a minute because I think you have a couple of things to say on this first topic. Ernie, tariffs, there shouldn't be a surprise that we're going to talk about them. They shouldn't be a surprise to anybody that voted. We talked about inflation. We talked about the economy. This week, the president-elect got serious on tariffs, made some major news with China, Canada, Mexico. What's this mean in rural America and Main Street America if these tariffs come to fruition as promised by the president-elect?
Well, apparently the bankers that we survey, bank CEOs in rural areas of 10 states, they don't think he's going to follow through. That is, they were very positive about President Trump in terms of the elections. Eight out of 10 said yes to Trump and no to Vice President Harris. So, but the bottom line is they don't think he's going to follow through. But who knows? Who knows what is in his? If we knew, then it wouldn't work. He can't. And he's the negotiator. I'm not. But this is scary for an economist. We, of all the folks on the earth, believe in comparative advantage. In other words, don't be raising Iowa hothouse bananas. Raise soybean and trade for the Guatemalan bananas. That's what we think ever since David Ricardo in 19th century England. That's how we see it. And this week, of course, he's talking about raising tariffs. Everything seems to be a response. His response is tariffs. You don't halt the illegal immigration across the border, then we'll put tariffs on. Of course, that's a huge trading partner for Iowa and this part of the country, especially in terms of corn, pork, soybean.
And part of his citing is about fentanyl, and it's a drug issue, but immigration has been a thing. Does that matter in this debate?
Well, it doesn't matter, but for an economist, that's outside our area of expertise. But we're saying, well, could this not be handled in a different manner rather than tariffs? Because retaliation would be there. And a lot of folks are saying, well, if he puts on a 10% tariff, that will increase our prices by 10%. That is dead wrong. It's wrong. Now, it will be higher prices, but how much? It depends on the competition from other sources. So the idea that a 10% tariff results in a 10% increase in prices is just dead wrong.
You wrote today, tariffs we'd have increases, we'd have higher prices, retaliation, slower growth, fewer choices. And I add trade imbalance. I mean, those are all possible that could happen.
Absolutely,
Could.
Absolutely. Well, we have a trade imbalance already.
Right.
The U.S. runs a trade imbalance.
It could get bigger, is what I should say.
Yeah, it will get bigger, and most of those are negative outcomes. Now, again, you don't negotiate by saying, well, we're flexible. No, this is a hard line, but he did implement tariffs in his first term, and those were carried over in the Biden administration. So again, these aren't positive signals from my vantage point or any other economist.
Well, Chris, that was exactly what we were talking about before we started rolling, is these tariffs that Trump had put in place, Biden kept in place.
Yes.
So in a sense, we've adjusted to it. So what does tariffs mean on the commodity trade?
Well, I'd say specifically with South America, Mexico takes a tremendous amount of our corn. They've been actually the best buyer of corn in the past 2 months. And a lot of people think they're anticipating, they don't know what the tariff's going to be, so they've bought a lot of corn. Now, corn's also at a 4-year low. We have prices that are depressed, so it's not unusual for somebody to say, okay, this is a good level for us to try and load up. So that's been one supportive thing, and you've seen it with old crop March against new crop. That spread came up 30 cents in the last month, and a lot of that was, I have to call it pre-buying, probably from Mexico. And we've seen on the flip side with China takes our soybeans. They really don't take a lot of our corn. They have, I was just reading this morning, they've basically stopped saying they want to have anything bid after the 12th of January because they're going to wait and see what happens. And they're in a situation, China's in a situation, their economy's slowing down, they're in trouble, they've been printing money, trying to stimulate their economy. And they've been, they haven't been on the sidelines, but they have not been as aggressive with our soybeans as possible, as they had been in the past. And part of the reason is we've got a big crop that's coming, that's been planted in South America. So at the end of the day, the tariffs are, I think they're baked in. I think they're, at least for the next 2 or 3 months. It is a futures market. I think we've already seen the market address for that. And we'll have to see where the rubber meets the road after January 20th.
You said a phrase in there that is money in the economy, inflation,
Right.
printing money, putting it in there. What's the state of inflation?
It's higher than the Fed would like to see it. Of course, it's short-term interest rates, but when the Fed raised rates, they've raised rates by 75 basis points, 0.75% since September, beginning in September, now in November. And this is not good. I mean, why are they reducing rates? We asked our bank CEOs about the December meeting, and 65% said no to another rate cut. In other words, these rate cuts are not doing the job, and there is a real concern about inflation, particularly if you add on tariffs as well. And we have some other issues here for farming that I haven't heard discussed, is the longshoreman strike, which may 17 East and Gulf Coast ports in early January. That may happen. We've got the Farm Bill, which is languishing in Congress, of course. These are tough potential issues of real concern for agriculture. I mean, here Creighton guarantees, I don't know about guaranteeing, but I get paid the same amount, about the same amount every year. That may be deserved as well, that I don't get big raises. But anyway, I don't have to, my income's pretty stable. This volatility that we're asking farmers to live with this, and this is really, really tough when you add on this tariff, the potential for tariffs, because there will be retaliation. There's no doubt about it.
Mexico's president said basically a non-starter and is very upset. You already mentioned, but let's discuss the comparative of currencies then. The dollar is high. I seem to remember an economist at this table telling
Yeah.
me a long time ago that a lower dollar is better for the farmer trying to sell goods.
Absolutely. That's another
We don't have a
hurdle.
low dollar right
No,
now,
we don't.
Ernie, but we have comparisons with what's going on in Canada and Mexico. What's that going to do to our trade?
Not good. Not good. I mean, the dollar is in my judgment, is probably going to continue to rise against the global currencies. Now, against the Canadian dollar or the Mexican peso, that's a different story. But nonetheless, our currencies will rise. And that hurts You're talking about tariffs and a stronger dollar, and that works against manufacturing, that works against agriculture, and that's what we survey at Creighton University every month, once a month. We do that with manufacturers and with agriculture, bank CEOs.
Chris, I'm going to ask you a question that came from Tim in Minnesota that kind of ties into the first two things we've talked about here. Tim wants to know, I know crop prices are low right now, but should I sell now before the tariff war kicks into high gear? That's presumpting that it's going to kick into high gear.
I think that given the marketing year that we had, which was very, very difficult, we didn't have a whole lot of opportunities, and the fact that we are at or near 4-year lows, I would say if you don't need to sell it, I would hold on to it, but I wouldn't hold on to it without a hedge, because I'm not going to sit here and say corn can't go another 30 or 40 cents lower if these tariffs turn out to be a problem. We've already seen big volatility in soybeans. In the last 2 months, we've had a $1.50 rally, a $1.20 rally, then a $1.20 break. Now we've had, especially the soybean market, I think that's the most sensitive and most volatile. So I would advise that if you don't need to sell it, wait and see if we get a recovery. But what you don't want to do is store it and not have a protective floor, because then you have an asset that's losing value, and then probably if you wait, you'll probably do what a lot of people do, where they'll make an emotional decision and sell it when they feel like they have to, or they have no other choice. So if you're going to store it, but keep a floor under it.
A market analyst at this table this week, Chris, said that last year at this time we had a high rally at the end of the year, and our high for 2024 was in January. Yeah. So seasonality is one thing, annual, year to year is another. Every year is different. However, does that change your answer at all?
No, because everybody's going to wait for a June or July rally. We had a little bit of a rally this summer, but it kind of fizzled. That's why 2024 was so difficult. We had our best prices, especially for soybeans, in December, January. And then with corn as well, we were above 502, I think, for the first day of January. I remember we opened up the January 2nd, and we actually gapped open lower. That was the high, 502 in corn, all the way until May. And then in May, we couldn't even get a $5 print. So I hope we don't live through that again. I would dare you to find anybody out there who thought that was going to happen. But when you have these, big problems, we're well supplied. Okay, there's plenty of corn and beans out there. That's part of the problem. You've got concerns about demand with what's going to happen with China and now with Mexico. So you have all these worries, and I think the market we could be in a sideways to lower market type action, kind of like we were in 2013 to 2020. You go back and look, corn traded in about a 50-cent range for a couple of years. So we could get back into that type of market while the market's trying to figure out what's going to happen with demand, what's going to happen with the U.S. dollar. The U.S. dollar is at 2-year highs. That always makes it more difficult for producers. And then the flip side, I think, is, we touched a little bit earlier on interest rates. If borrowing costs stay high, some farmers don't worry about borrowing costs. They're liquid enough, they don't worry about it. But for a younger farmer, for somebody that's just starting out, to have higher interest rates for your operating loan, that is a big factor. And I think that's something that gets kind of swept by the wayside in many cases.
Ernie, the global conflict in Russia and Ukraine has weighed on wheat, but we've had this threat of nuclear war for the last couple of weeks, much more louder than it has been. What is the impact of a threat like that on an economy? Is that more of a country, global, not as much a regional impact on an economy when there's something like that going on in Ukraine?
Well, agriculture is a global industry. global sector, and you do feel it telegraphed right back here to the midsection of the country. And our bankers are telling us, yes, it's having an impact, and we're seeing it. With the good news, if I want to bring some good news to the table, this month our index, the Rural Main Street Index, rose above growth neutral for the first time in 15 months. Now, on the flip side of that, agricultural equipment sales, as you're saying, operating loans, down for the 16th straight month. We asked the bankers about looking at farm land prices. What do they see ahead? 2.7% decline over the next 12 months on 12 months on average. So that's what we're seeing. And the question is, why is the Fed reducing interest rates? Back to your question earlier. Well, one theory, one potential is that they want. We're talking about a deficit of $36 trillion, the U.S. Treasury deficit. Our interest expense, the federal interest expense, is like this. Well, if you lower the interest rates, the Fed does, then that's less of a burden on the federal government. That's one potential outcome. So what does it mean for all of us? It means that we're probably looking at higher interest rates for a longer period of time. Now, they're low now. They're almost at the target level for the Fed. But long term, I'm looking at longer term. I'm looking at mid part of 2025, interest rates beginning to move higher. And of course, and again, what's the signal of that? Look at what happened to long-term interest rates when the Fed reduced short-term interest rates. They went up. Mortgage rates went up. Why? Because investors seeing more inflation out there, and they came down because of the Fed, what the Fed's actions on the short end.
I want to go back to part of your survey region. Okay. There's a lot of small manufacturing companies that make ag equipment. There's a lot of farmland in those areas that you survey. What is the impact of a lower priced implement, a lower priced farm that's selling? Yes, that will help our economy in the sense of a grand scheme, but it doesn't help those people trying to sell that piece of tillage equipment or sell that farm. What's the impact? Who has to pay the price to get us back to where we think the target should be?
Oh, absolutely. Another factor, I don't mean to introduce something else, but some of the areas, we're talking states, talking about, well, you can't sell your farm land to an outsider, say the Chinese. Now, that's, in other words, whose land is this, and what the disposition of that land? And it's the farmers, and you're right. It has an impact on across the rural Main Street economy. Retail sales, for example, housing prices, for example, and those are. I don't mean to be so down right now. This sounds like, well, that's the economist's job. We take away the punch bowl when the party gets started. You know, that's our job. But nonetheless, but look at long term. Long term, and Chris, you know this is better than I. The long term is you couldn't be in a better place and the best place on the best in the global economy than here. Long term, we're good as gold, and that's going to be because agriculture is good as gold. But this is a tough time right now.
Are you talking in the country or in the region of the grain state region?
The region.
Okay.
The region. I'm looking longer term. Farmland prices have come down some, but I expect long term they haven't come down as much as farm income has come down, as much as the economy's cooled.
We've touched a tiny bit on corn, but you're shaking your head. Do you want to answer one of those, or do you got something else?
Well, I think the one thing to remember is a lot of these, I'd say 95% of the land sales out there, it's cash deals.
Yeah.
Now, they'll finance their combines and things like that, but most of the land is being bought for cash. That's one positive thing. It's not like it's highly leveraged at this point yet. So that may be something, that may be a positive thing if you're trying to look for something positive.
Well, yeah.
With the fact that I would say, I mean, you would probably know the statistics better, but from what I understand, after being in this business for 25 years, most of that land is owned outright, which is, interest rates can do this and do that. That is the real wealth of this nation.
That's right. And the question comes up always is this a return to the 1980s? And the answer is no.
No.
It's not. We don't see that. Farmers entered this weakness with much better cash positions. And as you said earlier, Chris, about exports and farm input prices have leveled off. We've seen fuel prices come down. We've seen short-term interest rates come down. So our index moved above growth neutral for those reasons. Also yields. Yields are pretty darn good across the region.
I suppose we should actually talk about commodities, Chris. I just realized we need to get a couple of things covered here. In wheat, you saw an incredible turnaround in the health of the crop. It's gone from not very well to very well. What's that mean for the market long term?
Well, it's another negative because, again, the market's well supplied. And you talked earlier, we've been worried about Ukraine for over 1,000 days, right? And I think the market, remember, the market's a futures market, and that's when you look at wheat is at or near 4-year lows here in the U.S. I would say that for both Kansas City hard bread and also Chicago, the price to watch for better or for worse for the next 3-4 months is $5.50. $5.50 wheat is still pretty good. I remember wheat, go back years ago, it was a lot less expensive than that. So $5.50 is the big level to watch. Why aren't we out at $6 or $7? Because the demand's not there yet. There's no fear yet. There's no fear of inflation yet. So if you're going to talk about wheat, that's how I would say that. But yeah, the fact that we just got all this moisture and the crop looks the best it's ever looked, well, if that's the case, we're going to have more. We're producing more of what the world wants less of right now.
Speaking of producing a lot, corn, you basically have said hold as best you can. Let's go to beans then quickly. Yep. Because we've had, we still don't know if the August low is going to hold. We'll know soon enough, right, is what you said this week. But we still have this huge crop in South America. Doesn't sound like a good recipe right now ahead.
No, and that's why you've seen right now, I'm already looking ahead to 2025. New crop soybeans are at $10. They just went under $10, and they came back, so we're holding. So that seems to be the level, $10 new crop beans, about $4.30 new crop corn. And if you're a farmer, producer, you've already got to be looking ahead to those prices.
Are you locking any sales in at 10-12 here on that November contract? No.
No, I'd be defending it because literally 3-4 weeks ago we were $11. So we've gotten a couple dollar rallies. I think that's the most difficult thing for producers to do is to reward rallies when they come, because every time you get a dollar rally, you think, okay, this is the start of something. Here we go. We're going to go out to $13. This time last year, we were at $13 beans, and now we're here at 10.
And people were complaining then
that 13 wasn't enough.
And so that shows how quickly things can change.
They can change. So I don't think you get aggressively bearish. You don't sell down here unless you have to. I think you defend. I think you've got to make sure you know at what level you actually make money. There's that old expression I like to say, nobody needs practice farming, and so you need to know where your numbers are this year.
Cattle has to deal with an issue again with Mexico, but that's not trade related. That is disease. Or something. So what is the biggest, is that the black swan that's happening to this market?
If you want to look at the silver lining for the ag complex, it has to have been cattle, not only recently, but over the last 4 years.
So you're not done saying past tense, you're saying we still have you still think it's silver lining higher in cattle?
We are at or near record highs. It looks like we're going to make a run, especially in feeder cattle with the disease problem, and now they've stopped imports of beef from Mexico. It's 1.2 million head that possibly, are they going to close the border for 2 weeks, 2 months, longer? Nobody knows, but that's the reason, because we kind of had a bearish cattle on feed last week, and then we gapped open higher, and it became on this news that there's this parasite, and then they don't want it to get up here. So that's a positive for U.S. ranchers.
And it's about a 1.2 million head of cattle or something like that moves across the border.
Yeah, so that means all that demand is going to come, now it has to come from North American ranchers.
What about Iowa pork to Mexico?
Yeah.
I mean, other issue.
Well, I was going to ask you about livestock for a minute at the grocery store when it comes to these prices. I mean, the consumer prices, the consumer is still shopping.
Absolutely.
But it's not all tied to higher prices on everything from what the report said last week. Do you agree?
Right. And we've got consumer debt at record levels. So the mystery is how do retail sales, how do these prices continue? How do we have still strong demand at the consumer level? And the answer is I don't know. I mean, it should not see this kind of strength in, say, steaks or beef and pork and poultry. I think we're going to pay a price at some point in time. Now here we are entering, of course, Thanksgiving, and of course we've seen there what we've seen there. And now looking ahead to the Christmas season and the holiday season, it's looking reasonably good, but when you take out inflation, still not that strong. I'm sorry. The idea that this has been strong consumer is overstated. You take out inflation, it has not been that strong. But I think a huge issue is at the high end, the 20% versus the 80% in terms of income. Those who are in the 20% have been benefiting from a financial market, talking about the housing market, those who own homes as opposed to those who are trying to get into a home.
Ernie, you get the last, that was the last word.
That was it.
That was it. Ernie
Oh.
Goss, everybody. Thank you so very much. for
Thank
waiting.
you.
Chris Robinson, good to see you. We'll keep going here in a moment. All right, so hold on. Hold tight, everybody, because we are going to pause this analysis, continue our discussion about these markets in our Market Plus segment. You can find both analysis and plus on our website of markettomarket.org. This week, we released another installment of our grain marketing class in the third podcasting offering that we have here. That's the MTOM. Subscribe today at your preferred podcast provider. Next week, keeping tabs on the decision makers and connecting readers. Thank you so much for watching. Have a great week.
Market to Market is a production of Iowa PBS, which is solely responsible for its content.
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next, because a pioneer, our name, is our mission.
For over 45 years, Steiner Tractor Parts has shared your love of antique tractors, new parts for old tractors. Learn more at steinertractor.com or at 877-559-7887.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.